Thank you for the intro, Greg, and thank you, IDC, for having me here today to participate in your IDC WIN Fall Education Days. Before I begin, just wanted to mention that there have been a lot of great things happening at Equitable Life. Back in February, made some changes to our pricing in our product and our PAR product. Dividend scale announcement 6.25% for the 2023 to 2024. And we also just made some recent changes to our pricing August the 12th with new software and etc. So some really great things happening there. And with that pricing change, what we've done there is we've made ourselves more competitive right across the board in all ages, making us extremely competitive, both in single lives and joint lasted die. So make sure that you check out that new software update and take a look at that. We also made some living benefits enhancements and etc. to our CI as well as our UL. And one thing I want to add as well to our PAR, the living benefit, which is basically a ability to take out cash value from the policy on a tax-free basis upon a disability or long-term care claim. So you want to make sure that you take a look at that as well. So if you have any PAR cases, make sure to take a look at the new changes. Be sure to reach out to your local Equitable Life regional sales managers for those updates. Also want to make note that we made some changes to our compensation as well with our PAR so that the wealth is in line with the estate product with a two-year chargeback period. So we just made that change. So lots of good things happening. And I said before, stay tuned for a lot more exciting things happening around the corner. So this presentation here is about keeping our promises and ensuring that the values that we illustrate today will be there in the future with strong and stable dividends. Because at the end of the day, how important is it to ensure that the illustrated values that you show will hold true in the future? Whether that cash value is there for supplemental income or proceeds upon death to pass on to your business or your loved ones, you want to make sure that those values that you're showing today will hold true. So a couple things to keep in mind. We're going to be talking about some dividends here and etc. The illustrated values that we use are assuming that that current dividend scale that's being used is going to last for the duration of that policy. And of course, the dividends are not guaranteed and are paid at the discretion of the board of directors on an annual basis. Now, the dividends will vary based on the actual investment returns inside the PAR policy, the PAR account, I should say, as well as the mortality experience, how we manage our expenses, our lapse experience, claims, etc., that will affect that dividend scale. And as we know, the improved mortality and our lapse experience can improve the effects of the positive rate to those dividends. And as we know, those dividends may be subject to taxation. So with PAR, at the end of the day, we are earning a surplus that we can then pay out dividends to our policy holders. The PAR account has been around for quite some time with Equitable Life. In fact, we've been in business for over 100 years. We've had PAR since 1936 and been paying dividends ever since. Now, why that's so important is the fact that we've stayed committed to our policy holders here in Canada. We have never wavered from being out of PAR. We've always stayed in PAR. So I think that shows a great commitment to your clients that we are committed to PAR and we're committed and focused to our policyholders going forward. With the PAR account itself, so there's a couple things that we're going to talk about here: the PAR account rate of return and the dividend scale interest rate, which I'll talk about in a moment. But the PAR account itself, of course, is the assets that we're managing inside that PAR account. Currently, as of June 2023, the mix is about a 50% on fixed income, 35% in the equities, and then the balance would be policy loans and cash. Now, the PAR account rate of return is a short-term indicator on the investment performance. And what I'd like to do is point out a couple things. If I go back to 2008 and look at what the rate of return was in the S&P TSX at that time, it was about minus 33%. In that year, Equitable Life PAR account was a positive 4.92% in that calendar year. In 2022, similar story. The S&P TSX was down about 5.84%. and our par returned 3.04%. So when I look at the 30-year track record as well with our par account, how that return is, we've had no negative years throughout that period of time. So managed extremely well by our team and producing great yield. Now, the other part of this is the dividend scale interest rate. So it's going to be different than the actual rate of return on the par assets that we manage. The dividend scale interest rate will be determined by the investment component, as well as we'll be able to smooth it out to reduce any fluctuation. So that way we are reducing the volatility of that dividend scale interest rate, and is only one component of that dividend scale, but is one of the more significant factors, more particularly in the later years. So as we know, the dividend scale will change. It's sensitive to different factors that we've talked about, as far as mortality, lapses, improved expenses, etc. The one thing I will touch on the expense is the fact that because we're a mutual company, we're solely reporting to our policy holders, and we're very diligent in how we spend our money and want to ensure that our expenses are in line and that we are keeping it down so that it's benefiting the par account and the par policy holders going forward. And as we might know, the change in that dividend scale interest rate will affect future payments accordingly, whether it be positive and or negative. We've seen a decreasing dividend scale interest rate for most par companies over the last number of years. And dividend payments are not guaranteed, as you know, but they will never be negative. So one of the advantages of par is the fact that once the company pays out that dividend, it's vested, can't be taken away, and that balance will never go down unless, of course, you're taking money out of that cash surrender value. So what we're going to do here is that we're going to look at some real results, and we piloted this a couple of years ago, and what we wanted to do was to be able to go back to the advisors and policyholders and say, you know, if we were to go back 10, 12 years ago and look at the illustration back then compared to what the values are today, what does it look like? So our team put together some numbers and some comparisons, and we're going to look at a few policy samples here today, both using our estate product as well as our wealth accumulator product. And they will show the strength and stability of that dividend scale since 2012 when we started selling this version of these plans. Now, our returns since 2012 have been quite good and quite stable. And if we look at that blue line that's relatively flat across the board there, that's going to be our dividend scale interest rate. The orange line is going to represent the actual rate of return or yield on our par account relative to the S&P TSX and a couple other benchmarks there being the bonds and the GIC. So through focused, prudent investment strategies and risk management, our Equitable Life par account rate of return dividend scale have been very strong and stable for a number of years. And just taking a snapshot since 2012. And this is just a great indicator going forward that we can continue this balance and reduced volatility in the dividend scale interest rate. If we take a snapshot here, going back to 2012 and 2021, we see that our dividend scale interest rate averaged 6.5% with a standard deviation or volatility at 0.29, so very low. The actual yield during that same period of time, 5.95%, I'm sorry, 6.95% with a standard deviation of 2.21 relative to the other benchmarks, as you can see here, providing great yields with much lower volatility than perhaps some other benchmarks. So again, with our prudent focus and management of our investments within our par, we feel that going forward, we can continue our strategies in managing those assets. The one thing I'd like to point out is that, you know, Equitable Life has been in the par business for quite some time, as we know. And if we just go back the last 5 years, we've tripled the size of our par account. And the reason why I like to point that out is that even though we're growing that par account with great sales coming from the likes of you, the advisors at IDC, that the yield is still there. We're still getting great yields in our par account, and it's being managed extremely well by our investment management team. So now when we look at illustrative values, we can all we've all gone through this before. We have the guarantee values on the left column, and on the right column, we have the non-guarantee values. So when a client buys that policy from Equitable Life, they are provided with that illustration that shows those values over time, of course. Those illustrative values will be based upon their age, their sex, smoking status, the amount of coverage they purchase, dividend, riders, all that sort of stuff. The illustrations are important for the client to understand how the policy might work over time or behave, and particularly when it comes to those dividends that are not guaranteed. So the illustration will show the values that are guaranteed, the premium portion of the cash flow that is guaranteed as well as the death benefit, providing that they pay those required premiums. And the illustration on the right side, of course, will show the non-guaranteed values based upon what that dividend scale interest rate is at time for the duration of that policy. So again, the non-guaranteed values are based on the dividend scale in effect at that time. And of course, what we do know is that dividend scale will change over time. It's just a matter of how it changes on a year-to-year basis. And I think we do a fantastic job trying to smooth out that volatility in the yield. And we'll show a couple examples here coming up that we're not seeing any dramatic increases or decreases in that year-to-year DSIR or dividend scale interest rate. So how do we actually compare ourselves to the illustrated values and those actual values? Let's take a look at some samples coming up here. And in these samples that we're looking at, again, we're going back to 2012 and 2014, both with our estate builder product and our wealth accumulator product, using paid up additions. And the charts will show the actual cash values and death benefit at each of those policy anniversaries compared to the original illustration that was used. The actual values of the dividend scale change that has happened since the policy purchased at that time, so it's remained level. The original illustration is based on the dividend scale that was in effect at that time, and the dividend scale interest rate that was used back then was 6.8%. That was 2012 to 2014. So as we know, if you go back to 2012, our dividend scale interest rate was 6.8%. If we look at 2022, it was 6.05. So we've had a decrease of 0.75% during that particular time. So the real cool thing is that we're going to show here is that we've obviously seen a decreasing or declining dividend scale interest rate over a period of time, but how well did we stack up with our actual values in our actual policy? So first example I'm going to be looking at here is a policy issued in 2014 for female age 10, 100,000 using our 20-pay estate builder product. And what you can see here is that if we go back to 2014 to today, and we compare the results, the actual cash value that we have is $32.92 in 2023. Compared to the illustrated value of $32.85. So just marginally better than what was actually illustrated back then at current dividend scale interest rate. And at -1, which of course it's very diligent, so you should be showing -1 as well. We've surpassed the -1 rate. So how does that happen? So if we look at the dividend scale back in 2015, 6.8, 2016, 6.8, and we've seen decreases throughout those years here. Why is it that we can do that? Well, what's going to happen there is that it's not just the investments that we're growing the par account. That's going to contribute to the enhancement in those cash values, improved mortality assumptions, improved lapse experience, and improved expenses. So a lot of those things are going to contribute to that growing value, both on the death benefit and the cash surrender value. We'll take another snapshot here of a policy that was issued back in May 2012 for male, age 52, life pay using a wealth accumulator, and similar results here. The cash value is slightly lower than what the illustrated value is, from $424,000 to $428,000. And the death benefit is very close to what was illustrated back in 2012. Third example, so we're trying to give you different samples here with different ages and et cetera here. So now this one here, 2012 issued for a male age 8 for 20 pay estate product as well, PUA. Again, our cash value is $5,267 at year 2023 compared to $5,277 illustrated back in 2012. So very, very close. And the death benefit is almost bang on as well. Example 4, issue 2014, male 47 now, $600,000 policy on the life pay with our wealth accumulator. Similar results. The cash values that are actual results are slightly below what the illustrated values were back in 2014. And the death benefits just marginally off as well, based upon the current DSIR compared to the values that were illustrated back in 2015 as well. We have 2 more examples. Male, 46, 20 pay estate builder, very similar results on the cash value, almost exactly the same as the illustrated values compared to what the actual cash values are today as an example, and the death benefit, same thing, almost exactly the same. One more example, age 49 female, back in 2012, 65,000 annual premium. Our actual cash value is slightly below what the illustrated value was at current back in 2012, and the death benefit very close to what was illustrated back then. So pretty compelling results there. And just to put this into perspective, I was at another conference last week, and I was talking to an advisor about PAR, et cetera. He had an existing policy for a client, and it was 8 years in, and he was asking questions about it that we were addressing. But then I asked him, I said, just by the way, did you ever, take a look at the actual values compared to what you illustrated back then? And he had kept the illustration, of course, from when he first put the policy together for the client. But he said it was remarkably close how close we're with our values. And so just case in point that, it was really interesting to see for him that, the values that we showed back then 8 years ago were almost exactly the same of what those actual values are today. Excuse me. So what do these examples tell us? Well, those actual values closely match up to those illustrated values. Excuse me. The actual 2023 values are very comparable, not only current, but also at -1. And I think you see going forward that, I think we're well positioned to continue this. Of course, the future dividends, et cetera, are not guaranteed, but I think the way that we manage our account, how we manage our expenses, et cetera, puts us in a really good spot here. And at the end of the day, providing these strong, stable dividends, what does this do? I think that these results will provide some confidence for both you and your client, because even the fact that if we have a decreasing dividend scale interest rate, that we have favorable experiences in managing the expenses, as I mentioned, mortality, policy loans to offset that. So again, I think we're in a really good spot going forward as well. So these results here, although the experience are not guaranteed going forward, but we're tracking to those illustrated values very closely. So I think just this is going to provide additional confidence, not only just for the advisors, but for the clients, knowing that the values that they're presenting today will be there in the future. And the one thing with being a mutual company, we're a policy holder company, so that's what our best interests are focused on, our policy holders and the PAR account. So you can look ahead with confidence, both you and your clients, providing an illustration that is going to be backed up by strong and stable historical dividend results due to continued focus on the management of our par accounts and our pricing, etc. Our goal is to ensure that we meet those guarantees of the product and provide long-term growth to support that dividend scale. You can feel confident as well when presenting these illustrations to your clients with the prudent focus and management of our par accounts, providing lifetime protection to your clients with that opportunity of growing tax advantage growth. So I just think that this particular piece, the marketing piece, is called 2075 and is available on our Equinet. And if you want to download it or reach out to your local RSM, I'm sure they'll get a PDF copy to you, but it just really helps illustrate the values of the policies that is available over a period of time. Again, this particular piece, 30-year track record of our dividend scale interest rate as well as the par. Again, that form is 1505. Another form is 1038, understanding par, which has a lot of that information in there, the historical information. So make sure you want to check out those pieces in particular. And I'm going to conclude by just going over a couple things here about Equitable Life. Equitable Life, again, has been around for over 100 years. We've been dedicated and focused as a mutual company here in Canada to our par policyholders, and we're focused here in Canada. So we're proud to be Canadian. We only operate here in Canada. We're based in Waterloo. We have no other operations outside of Canada. And being a mutual company since 1920, we've been in business. We're one of the largest mutual companies in the industry in Canada, focusing again not on quarterly results, but long-term focus for our policyholders and our par. And we're owned by our policyholders, not shareholders, which is a significant difference as well. So together, what we do differently is that we provide reliable and proactive, comprehensive experiences to our clients and advisors, providing comprehensive solutions, enabling us to build strong and enduring relationships with the advisors and IDC as an example in the MGA market as well. And our strategic focus, of course, with no shareholders, our success is measured on delivering consistent growth organically. And our mutual status allows us to focus on delivering improved focuses on personalized services, security, and well-being for our policyholders. So Mutuality has many benefits. First off, we focus on our par policyholders' interest at all times. Again, those dividends that are being paid out to our policyholders are sharing in the success of our company. The company provides the ability of voting rights for our policyholders, again, with no shareholder focus. We focus on the customer. And again, the policyholders will elect our board of directors. And one other thing I'd like to mention here is about the performance of LICAT. So LICAT, again, is a life insurance capital adequacy test recognized by the financial services industry here in Canada. OSFI regulates it at 100%. Our goal is to have 120%. So what this measurement is about is to ensure that we have enough, all insurance companies have enough assets to cover their financial liabilities, being claims on death or CI or even segregated fund contracts. And I've been with the company for almost 5 years, and LICAT is reported on a quarterly basis. There have only been 2 quarters that I'm aware of that we have not been number one in LICAT. So what this tells me is that we are very strong and stable. I think this is a great number to show your clients as well, to show them that, you know what, we are strong, we're stable, strong, stable dividends, financially strong and secure going forward. So we're in a really good spot. DBRS, we get a high rating, similar to other carriers, but again, we like to just disclose this. That's been very consistent over the years. We're providing, in my mind, excellent service in a number of different areas, dedicated customer service team, expert underwriting team. We're always looking at ways of enhancing, improving our systems and our processes. And we're continually enhancing our digital platform as well to ensure a smooth and positive experience for not only the advisors, but for the clients as well. So our blend of outstanding service, leading edge technology, Equitable is a great place to have a partnership with. We're seeing that with about 90% of our applications are now being done online, digitally. And with that process, easy complete online with the ability of using the easy upload to upload documents to those applications. And with the e-signature and delivery makes it a very seamless and easy process. So choosing Equitable Life, broad competitive product shelf, value-added solutions, underwriting made easy, regional sales support across the country, online tools at your fingertips. We hope that you've enjoyed this presentation, and we look forward to working with you. For further details of this presentation, please feel free to reach out to your local Equitable Life Regional Sales Manager. We want to thank you for attending this session today, and I hope you enjoy the rest of your time with the IDC Fall Education Days. Thank you.